Welcome to TheoTrade. This is Don Kaufman. You are watching the Theo Weekend Update for August 4th, 2018. All right, let's do a quick recap, of course, of this past week of trade. Then we're going to be, again, very forward-looking, a lot of opportunity inside of the marketplace as we see it. First and foremost, let's talk about the S&P futures. Now, not everybody is necessarily a futures geek, and you don't have to be, but okay, levels inside of the futures absolutely matter. And if you've been watching some of these weekend updates, some of the updates on a day-to-day basis, you'll know that a very specific level happened to be hit inside of the S&P futures. For those of you that do track what we call kind of our gravity points, 2841, that's for the most part where we closed on the week. 2841 is hit. It's what we, again, term a gravity point. Now, those gravity points are explained in a number of other videos. Nevertheless, kind of a quick recap of what a gravity point happens to be. It's kind of a concentric area of risk of major trading firms. For the most part, these big trading firms, they're both long and short. A lot of them use what we term delta neutral strategies. We actually get drawn into specific levels. Now, we're capable of marking those levels by watching volume all the way down to like a 1-day, 1-minute chart. And eventually, we can actually determine where these specific levels happen to exist. One of those levels, of course, is right at 2841. And people, we literally tracked right to it, stopped there on a dime. Why we call them gravity? Because the market almost feels like it's being pulled into that level. And before I go any further here, it's critically important to be able to discern if we crack above that particular level and really get above, like when I say 2841, you start getting up to like, 2845, 2846, okay, we could actually see the S&Ps appreciate into really all-time highs. And I'll give you a specific strategy here in just a few minutes. When we get over to the charts, we're going to give you a specific strategy. If the market's going to burst to the upside, let's go after it. And it's something that it's going to use a ratio backspread. It's not going to cost you anything up front. I think that's critically important. So if you want a strategy and say like, listen, I'm not sure if the market's going to crack to the upside, but if it does crack to the upside, in a moment here, I'm going to show you that ratio backspread. Another thing that we want to be mindful of in this next week of trade. Again, I'm not doing a lot of recap here. I don't want to hear one more thing about $1 trillion Apple out there. Enough. Okay? This is not talking head kind of garbage here. We want to get into really the context of what trades you can take in a given market, and specifically what trades I'm going to be taking this next week. Now, if you look at the next week of trade, expected move in the SPX. What is expected move? It's the options market kind of dictating risk. Now, there are options that are Monday options in the SPX. There's Wednesday options. There's Friday options. The Friday options carry the most weight. That's the expected move that we have tendency to look at. The expected move of this previous week of trade was $34.60. Now, as I said, I don't like to be backward looking, but you have to have the last couple of weeks, okay, under your belt to understand the volatility, and the expected move this next week has contracted and contracted substantially. So last week, again, was a $34 expected move. This next week is about a $28 expected move. Not half bad. You're thinking, what's $6 amongst friends? It's big in terms of implied volatility, and I'm going to tell you exactly why. Last weekend, I talked about be a net buyer, okay? Be a net buyer of options really on a intraday basis. You want to be long gamma. And the exact same thing is going to hold consistent in this next week of trade. The point I'll make about last week is we had one trading session where we moved over $30 in one trading session from low to high, all right? That was supposed to be the expected move for the entire week, meaning that, you're supposed to move in a $34 range all week. Yeah, we did that in one day. Well, this coming week, we have a $28 expected move. The market, come on, I can put that behind it in no time at all. So if we're capacity to move over 28 bucks, it makes sense on an intraday basis to be again, a net buyer of options. Now, Let's kind of go into the marketplace as a whole. The Nasdaq last week moved up about 1%. The S&Ps moved up about 0.8%. But when you start looking in detail, and I'll show you this in a few minutes, you start looking really at detail at a couple of specific positions that we happen to have on. We've got positions in Caterpillar, we've got positions in Boeing, we've got positions in Morgan Stanley, okay? Recognize all three of those underlyings on the week happen to, in fact, be down. Right? And again, we'll show you that here in a couple of moments. The other thing that really stood out to me is the sector that I've called kind of the linchpin of the marketplace. What is it? It's the financials, it's the XLF. The XLF, ironically, finished the entire week 1 penny change from where it was in the previous week. So we have the financials completely and utterly flat. And I say that they're a linchpin in the marketplace. Listen, we had a little bit of a tech debacle. The world was saved, of course, by Apple. That kind of, lifted markets a bit throughout the course of the week. The question, though, in this next week is some of this tech, disaster, is it over? And we start to look again a little bit more detailed at this. You're even going to see underlyings like Google did not fare well throughout the course of the week. So again, what do we have here this past week? Well, we have Apple and Elon Musk saving the day. Nevertheless, okay, the charts are going to tell a little bit of a different story. Let's get to it. All right, to the charts we go. We're going to start once again with the S&P futures. That was kind of a big topic of conversation. I got a ton of emails in this regard, kind of calling out specific levels. And once again, we're hitting a gravity point. As I said, for those of you that don't necessarily know where those gravity points happen to be, allow me to state a number of them. I'm going to drop from, this is a 1 day, 1 minute chart. I'm actually going to drop all the way back to 180-day 4-hour chart. And you can start to see very specific, again, very specific, what we term gravity points on your screen. Of course, the latest gravity point happens to be right around this 2841 handle. And that's right in this neighborhood here. Again, that's 2841. Now, we picked up on this. People, this was all the way back, okay, in mid-January that we actually constructed this particular line on the screen. And this is just a price level that I'm using on the thinkorswim charts. Now, again, this is the level that's obviously in play right now. And the comment that I made just a few moments ago in the video section is that if we break above this, okay, we're, going to launch ultimately for all-time highs, and that there are a number of trades that you could build around this. Now, I want to be very, very clear kind of in this statement in the context of the trade. I want to be able to build a trade, not necessarily, and I want to make this clear because I think things get kind of misconstrued when you tune into these videos. I'm making a trade not necessarily because I am bullish. I am going to be putting on a trade, okay, simply, well, what if we do break to the upside? As a trader, okay, you cannot be incredibly short-sighted. You also have to be open, okay, to both sides of a marketplace. Now, I am and happen to be undoubtedly a bear longer term, especially in this marketplace. Nevertheless, okay, I am also an opportunistic trader, and I see opportunity in here with a marketplace that could be poised, okay, to crack to all-time high. Now, what kind of a trade might I want to utilize if we think we're going to go to an all-time high? I'm going to use very short duration, again, very short duration back ratio type spreads. And this is a spread that I can put on pretty much on a week-to-week basis, okay, dependent upon where the market happens to be. Now, let me give you just a brief example here of a back ratio spread, and this is worth taking the time. So, in the end, it's not just looking at levels and saying, oh, I think we're going to go up and I think we're going to go down, okay? It's building specific trades. I mean, that's what we do here at TheoTrade. It's about trade logic, and it's about constructing a position that can be effective, okay, in this marketplace. Now, these spiders, and why did I immediately jump to the spiders? So I was talking about the S&P futures, okay, but then I immediately jumped to the spiders. The spiders just happen to be the friendlier, kindler, gentler, if you will, place to be able to do business. All right. If you're experienced, of course, you could step up into the SPX. The SPX is the mother of all products.
also frequently referred to here at TheoTrade as the widow maker. So if you do step up into the SPX, people, you better know what you are doing. Well, in this particular circumstance, I'm just going to go out a few days. I'm going to go out to the Friday options, and that's this coming Friday. And I'm going to go out and I'm going to sell, okay, one contract. So I'm going to sell one contract of these 284s, and I'm going to sell them, trading about 93 cents. And then I'm going to turn around and I'm going to buy, all right, I'm going to buy 3 times as many 286s. Okay. Why? Well, they're trading for about 26 cents. So it's a short 1, okay, long 3 position. Now, one of the things I'm also taking advantage of, and one of the reasons I'm using the ratio back spread, is the implied volatility. The skew is huge. So I'm selling an option that's right around a 6.6 vol, and I'm buying an option that's right around a 6.1 vol. So it doesn't sound like a lot. You're like, oh, that sounds exciting. There's a 0.5% skew in your favor. 0.5% is actually quite large. I mean, it's the difference of looking at like a $6 stock, okay, and a $6 and, for instance, 60-cent dollar stock or a $6.50 stock on a percentage basis. These are actually fairly large denominations that we're looking at here in terms of how big that skew happens to be. In effect, what is the position going to work out to look like? Well, here it is. I am, again, selling the 284s one time, buying 3 of the 286s for about a 19-cent credit. Now, I've already thrown this over into the Analyze tab to just give you a quick look. Now, before we go any further, one of the important things to recognize is, okay, in a spread like this, there's what we term, and I'm going to kind of zoom into it, okay, is what we term kind of the valley of death. You can take losses in these spreads. Now, I don't want you to get ahead of yourself and think, oh, this loss could be absolutely hideous. Okay. Right in this neighborhood, you could take a loss on this spread. And that loss would be achieved, okay, if we're right pretty much on, okay, that 286 level coming into Friday. Friday means everything. So how could you mitigate some of the risk in this particular trade? Well, if the market opens on Friday right on 286, doesn't look like it's going to do anything, just close out of the position. You'll take a very, very mild loss. This harder edge line, that is at expiration. That's with no time remaining. That's by the close of Friday. Anyway, you're probably only taking about half the risk, okay? In the case, if you were to close this by Friday morning, you would only really achieve about half the risk. All right, so moving on again, you can see kind of the valley of death. And, one way to kind of simulate this, and if you do have any type of analytical, software, what you can do is just kind of push the date forward, right? And you can see how the trade matures through time. And the thing that concerns us is, all right, so today happens to be August 4th, but when is this thing going to expire? This thing's going to expire on the 9th. And I want you to see, this is kind of the morning of the 9th. That's the risk graph, the morning of the 9th. And if you kind of zoom in over here, you're like, okay, I get it. It's not that bad. But one of the other aspects I think it's worth looking at in this particular trade, and I'll back up the date over here for just a second. One of the other aspects, you got to look at the break-even point. So the break-even point is all the way out there at 286.92. Now, if you go back over here to the trade tab, and again, we're getting into some pretty hardcore logic surrounding this particular back ratio. Why? Because again, this is a pretty viable strategy. You get a 19-cent credit. So if the market completely and utterly tanks from where it is, it doesn't really matter. You still get to keep your 19 cents, right? I mean, we'll look back at the Analyze tab. So what if the market tanks? You keep your 19 cents. And if the market explodes to the upside, gold. But let's actually get into the context of the fact that we have to trade outside of the expected move. So let me make this clear what that means. So the underlying is trading at 283.60. Okay. I want you to take that and I want you to add the expected move. Add $2 and basically 86 cents. So we're just going to add $2, okay, and 86 cents to that, which is effectively our expected move, equals 286.46. Now, if you think about this, I mean, you're going to look at this for a second. You're going to think to yourself, wow, that's, really, really close. Really close to what? It's really close to the break-even point, the BEP, the break-even point of the ratio spread that we just created. The ratio spread had a break-even point just a few pennies above, all right, the expected move. So what I'm telling you is simply this, and you're like, well, what does all of this amount to? It amounts to this. A marketplace is supposed to move within a given range. Like right now, that range is 283.60, okay? We need us to come to the upside, and the expected move says, well, we're supposed to come all the way up here to like 286.46. Well, guess what? We would need us outside of that expected move. So again, a burst to the upside is where this particular trade would in effect become profitable. And that's what's important to take away from this example. And this is a trade that, hey, listen, if the market opens kind of where it is right now, no problem, right? You'll be able to put this particular trade on. Although one thing I do want to kind of mention, if the market starts to move, I'll reprice it on Monday morning live within the TheoTrade chat room. In fact, we can even do a bit of a coaching session specifically on those ratio back spreads, because I think it's in play right now. The skew kind of demands it. So another aspect that I wanted to cover, because again, I wanted to go through just a few things. As I said, this entire week, okay, was just marked by the fact that Apple exploded to the upside, right? If you look at some of the other major players lately and underlyings that have been really under duress, okay, here we have Netflix, for example. Netflix still closed down on the week, right? We'll look at Google, okay? Google, down, but mildly on the week, okay? Of course, you want to look at Facebook. Facebook still had, again, it's very mild, but had a little bit of sell-side activity throughout the course of the week. Again, and I can continue on. Amazon, all right, Amazon closed the week. Again, here, 1, 2, 3, 4, 5. All right, we peaked out, for the most part, kind of flat on the week. So most of your technology stocks completely and utterly stalled. Right? Meaning they didn't really change very much. Then we had the financials. The financials, literally, if you go 5 days back, okay, they opened the week and closed the week at the exact same level. So for the most part, they were massively unchanged. Well, that's what matters. Then you look at the S&Ps and you think, well, how could the S&Ps chug to the upside? Well, I have one reason for you. It's Apple. There's that much market cap into this beast. I mean, that's what it comes down to. There's just that much market cap. But so Apple saved the day. But really, I'm still going to progress ever so slowly into, and I mentioned this kind of earlier last week, I am now stepping in ever so slightly and starting to short some technology. Very, very selective. Again, I will mention that throughout the course of this next week in the TheoTrade chat room. I don't want to get too specific right now, but we're going to take you through a number of different underlyings. The other thing I wanted to kind of recap are specifically some of our positions. Now, for those of you that have been following us for quite some time, I've been short Caterpillar pretty much to the cows come home. I initially shorted it all the way back here in early January. I did not short the shares outright. I actually used deep in the money puts. Okay, Caterpillar this week closed down on the week. Again, marked with a week with earnings, big, huge reversals in here. It was wild. Taking a look at Boeing. Boeing is another short candidate. I've been short Boeing from quite some time. I got to tell you, I've had a love-hate relationship with Boeing. It hasn't necessarily worked, but on the week, again, Boeing is like the staple to the Dow, right? The Dow needs Boeing, okay, to maintain its levels, and right now that level happens to be almost the mid 25,000. Nevertheless, Boeing did fall throughout the course of the week. Another major position that we've got on happened to be none other than Morgan Stanley, and ironically, Morgan Stanley has backed off quite considerably on the week. So you look at a week like this, and again, as I stated, earlier, I am a bear in the marketplace, but I'm a very selective bear right now. I am definitely short in a number of financial products. As I said, I'm short Boeing, I'm short Caterpillar, and this coming week, you guys are going to see me step in a little heavier into technology. The only major tech company that I'm short right now happens to be none other than Intel, and you can see I carry position in Intel all the way out here. I am long. I own the 55 puts, which is in effect a bearish position. So I've been riding Intel to the downside, okay, and that also, like this week, we did see a little bit of a bid back to Intel following its earnings, but this may be an advantageous position to get short. More to come this week on TheoTrade. Have a great weekend, everybody.